All right, how about some reg best bets? You taking reg in the next couple days? Make sure you're up on your partnerships, your corporations, the new tax credits under the Tax Cuts and Jobs Act, and of course, like-kind exchanges. Those are some of my best bets, so let's get into it. Here's a partnership question. They want to know what amount represents Kent's initial basis in the partnership. So we got Kent and Steele forming a partnership as equal partners. Kent contributes cash of 6,000 and an asset that has a basis of 45 subject to a mortgage of 10, and the partnership is going to assume the mortgage. The asset has a fair value higher than basis, it usually will. What amount represents Kent's initial basis in the partnership? And of course he's putting in 6,000 as well as the asset, and the asset has a mortgage on it. This is a typical CPA exam question on partnerships. They want to know how much is the partner's basis. So the first thing I would do is I would start with the basis of 45,000 on the property, and I would subtract the entire mortgage of 10, bring it down to 35,000. Then you got to add back what this particular partner is responsible for, and since Kent is an equal partner, you'll add back half of the mortgage. So 45 minus 10 is 35, and then add back half of that mortgage of 5 brings you to 40,000. And that's not a choice because we forgot to add the cash of $6,000 that Kent also contributed, and that brings us to 46,000, which is letter C. So start with the basis of the property, subtract the full amount of the mortgage because he's getting debt relief, and that brings you down to 35. But he's responsible for half of that mortgage as a partner, so add back half of the mortgage. Now you're up to 40, and then don't forget to add the cash because he's putting in cash. That means he's got more at risk, and that's where your basis comes from. So the answer is 46,000. The other kind of partnership question I want you to make sure you understand is distributions. Both liquidating and non-liquidating distributions from a partnership are always tested. So Herb's basis in his OHR partnership interest is 50,000 at the beginning of the current year. So there's his basis, 50. During the current year, he received a non-liquidating distribution of 25,000 in cash, plus he got land with a basis of 15 and a fair value of 20. What's his basis in the land? Okay, so they ask you this kind of thing. First thing you got to do is subtract the cash from his $50,000 basis, which brings his basis down to 25. So now you got Herb at a 25,000 basis. Then what about the land? Well, when assets come out of a partnership, they come out at basis. So now you're going to take the 15,000 for the land and subtract that from the 25,000 basis, and Herb will still have a remaining basis in the partnership of 10,000. But don't choose A because they're not asking you for Herb's remaining basis in the partnership. They're asking you for Herb's basis in the land, and it would be 15,000 because assets come out of a partnership at basis. So the answer is B. So while B is the answer, 15,000, that's the basis of the land to Herb. In the next question, they might ask you, how much is Herb's remaining basis in the partnership? And then you would say 10,000 because after the cash, that would have brought his basis down to 25. And then after the land, he'd still have a 10,000 remaining basis because this is non-liquidating and we don't have to zero out his basis. But what if it was a liquidating distribution? So same facts, but what if it was liquidating? Well, then you'd have to zero out Herb's basis. So first you'd give the cash of 25 and apply that to the basis of 50, and you'd have 25,000 left for Herb's basis. Now you have this information given about the land with a basis of 15 and a fair value of 20. Well, if this was non-liquidating, we just saw that the land would come out at basis. But now that we have to zero out Herb's remaining 25,000, we would take the land out of the partnership and give it to Herb with a basis of 25,000 because we need to zero out Herb's remaining basis. So in that one instance, since it's a liquidating distribution, Herb's basis in the land would be 25,000 and Herb would have no remaining basis in the partnership. So the answer to this one would be D. So whenever there's a liquidating distribution, make sure that you zero out the remaining basis, even if that means that the asset has to have a basis higher to the partner than it did in the partnership. So the general rule is assets come out of a partnership at basis, but in the case of a liquidating distribution, you're going to have the asset come out with a basis at whatever it needs to be to zero out the partner's remaining basis. So that's a very good place for the CPA exam to go. All right, now let's talk about corporations, because they'll ask you maybe a C Corp question on formation of a corporation, the 80% rule. And you're watching out for the services guy, because whoever contributes services in exchange for stock, if they get more than 20% of the stock for their services, then they don't meet the 80% rule, and then any built-in gains are taxable. So X, Y, and Z organized Bingo Corp, and they want to know in this question, what amount of gain did Z recognize from this transaction? So they're going to tell us about X, Y, and Z organizing Bingo Corp. X receives 10% of the capital stock in Bingo Corp for the organizational services that he rendered for the benefit of the newly formed corporation. So performing services and getting stock, but he only gets 10% of the stock, so we don't have to worry about the 80% rule. None of these built-in gains are going to be taxable. So the question is, what amount of gain did Z recognize? Well, we got to see what Z put in. It looks like Z, if we skip down, contributed assets with a basis of $60,000 and a fair value of $70,000 and got 50% of the stock. Well, as long as they meet the 80% rule, Z's not going to recognize any gain. So the answer is going to be 0 because they meet the 80% rule. Remember, X put in services and got 10% of the stock. What about Y? Y contributed assets with a basis of $5,000 and a fair value of $20 and got 40% of the stock. Z, we said, contributed assets with a basis of $60 and a fair value of $70 and got 50% of the stock. So those who contributed property, Y and Z, came away with at least 80% of the stock. And why is that important? Because now none of those built-in gains on the properties are going to result in any gains. So when they ask you how much gain Z recognizes, it'll be 0 gain because they met the 80% rule. Z will recognize no gain. Y also will recognize no gain. So the answer is A. And because they meet the 80% rule, the asset's going to transfer into the corporation and be picked up at the same basis. So this question is asking with the same facts, how much does Bingo Corp value the asset contributed by Y? Okay, not by Z, but we can answer the Z question too, because Z's asset had a basis of 60, and that's what the corporation's going to pick up. Corporation will pick up Z's asset with a basis of 60. But this question's asking about how much does Bingo Corp value the asset contributed by Y? Well, same thing. What's the basis of the asset contributed by Y? 5,000. And since they meet the 80% rule, the basis of that asset will roll over into the corporation, and the corporation will pick up that asset contributed by Y with a $5,000 basis. So the answer is C, and there'll be no gain to Y, just like there was no gain to Z. So the answer is C. All right, now they're going to ask you about X, because X was the services guy. X provided services with a value of $10,000 to the corporation and got 10% of the stock, remember? Okay, so now they're going to ask you how much ordinary income does X, the lawyer, recognize for performing the legal services for the corporation? And it looks like the answer would be $10,000 because that's the value of the services provided by X. But they told you that the value of everybody's stock in Bingo Corp was $120,000. And since the value of everybody's stock was $120,000, then all you would have to know is what percent of that stock did X get for providing services. And they told you earlier in the question that X got 10% of the stock for performing the services. And they'd have to tell you that, and they did. So as long as X got 10% of the stock, then X's value received for the services was 10% of the $120,000 or $12,000. And that means X would now be taxed on $12,000 of ordinary income instead of $10,000 of ordinary income. So be careful with a question like this. The answer is 12,000, not 10,000. Why? Because whenever you perform a service, the fair value of what you get is ordinary income. And the fair value of what X got was 10% of the total value of all the stock. Now, if they didn't give you the total value of all the stock, then it would have been easy. Then X would pick up 10,000 of ordinary income, because sometimes they won't give you the value of everybody's stock, in which case the answer would be 10,000 ordinary income for X. It would never be zero, and it would never be a capital gain. It would always be ordinary income, because anytime you perform a service, the fair value of what you get is ordinary income. So C is the answer. And that's the kind of question they could easily ask. So that was a three-part question on the 80% rule. Make sure you understand how that works. All right, a quick question on a trust. If the creator of a trust sets up a grantor trust instead of an irrevocable trust, which of the following is correct? All right, you should know about a trust. An irrevocable trust means all the income from trust assets is no longer taxed to the grantor, but taxed to somebody else, like either the trust or the beneficiaries, depending on who gets the income. But if it's a grantor trust instead of an irrevocable trust, then for tax purposes, that's not a valid trust. So all trust income would still be taxed to the grantor as if no trust was created. However, so one is right. Two, if the grantor dies before ever revoking the trust, trust assets will pass to the beneficiaries. That's true even for a grantor trust. So a grantor trust is still a trust for legal purposes, but it's not a trust for tax purposes. So if a grantor sets up a, quote, grantor trust instead of an irrevocable trust, that means it's still a trust for legal purposes, but it's not a trust for tax purposes. So all the income would still be taxed to the creator, to the grantor, as if no trust was created, because they didn't set up an irrevocable trust. But if the grantor dies before ever revoking the trust, then it's still a trust for legal purposes, and the trust assets will pass to the beneficiaries, and you won't have to worry about probating the will. So C is correct. All right, how about this one? Now we're looking at tax credits. Which of the following is correct with regard to the Tax Cuts and Jobs Act? So some recent tax credits that the exam might ask about. One, child tax credits are $2,000 now for children under 17. Yes, if you have a child under 17 at the end of the tax year, then when you fill out your tax return, that's worth $2,000 as a tax credit. Once they hit 17, though, then you lose that $2,000 amount. What about Roman numeral 2? There's a family tax credit of $1,000 that includes non-child dependents and children over 17. Well, that's partially right. You do get these family tax credits now if your kids are over 17 and if you have maybe an elderly person living with you, but that's a $500 credit, not a $1,000 credit. So the answer would be A, one only. All right, here's another tax credit that they're very likely to ask you about, and that's the tax credit for family leave. You know the CPA exam, they like to be a very relevant body. So if something's new, they want to ask you about it. And this is brand new. Connie works for Melvin Corp in 2019 and earns $4,000 per month in gross wages. In June, Connie goes on family leave for 90 days, so she has to miss work for 3 months, but she continues to get paid. Look at this. She receives $2,000 per month while absent from work. So the employer, Melvin Corp, continues to pay her $2,000 a month, not her full salary of $4,000, but $2,000 a month she still receives even though she's not working. If all other requirements are met, how much credit for family leave does Melvin Corp receive in the current year since they're continuing to pay her while she's not working? And this is a brand new tax credit and you got to know something about it. So here's how it works. The new credit is 12.5% of whatever the employer paid the employee during family leave. So while she was on family leave, what'd she do? She got paid for 3 months at $2,000 a month. That's $6,000. 12.5% of that, that's the credit amount, is $750. And that's the credit that Melvin Corp's going to get for making this salary, continuing to pay her while she's on family leave. It's 12.5% of the amount paid. Now, there is a maximum credit of 25% available instead of 12.5%, but that's if the employer pays full wages to the employee while out on family leave. So the general rule is you pay at least 50% of that employee's normal wages, and that's what they did, then you qualify for the tax credit. And then if I have to pick one area that you might see a sim, it would be like-kind exchanges. Because there's even something new now with like-kind exchanges. Only real estate qualifies for a like-kind exchange. Used to be you can trade personal property too. Only real estate qualifies. So here's an example of a real estate like-kind exchange that they might ask you about. A taxpayer holds investment land with a basis of $30,000 and a fair market value of $40,000, and the taxpayer is going to exchange that for like-kind property with a fair market value of $36,000. So they're giving up $40,000 to get $36,000, but to even up the trade, they're going to receive $4,000 of cash. And we know cash is boot, and that could give rise to a taxable event. So first we have to determine what they call the realized gain or the accounting gain or the economic gain, and that's determined by taking the fair value received, which is $36,000 plus $4,000 in cash, or $40,000 received, minus the basis of the old property, which was $30,000, and your realized gain is $10,000. But the boot received is only $4,000. That's the cash. The lower number is always taxable in a like-kind exchange. The lower number of the realized gain of 10 versus the boot of 4. So that means 4,000 will be taxable even though it's a like-kind exchange. So the taxpayer is going to report a gain of 4,000, and then they're going to ask you what's the basis of the new property. And the answer is, since all the boot is being taxed right now, the basis doesn't need to be reduced. So keep the basis the same as it was before. So the basis was $30,000 before, it's still $30,000 now. So in a like-kind exchange, as long as all the boot's being taxed, don't lower the basis. Now, if this were a sim, they'd give you a little variation on that, right, in the next part. Now they'll tell you that the basis was $39,000 instead of $30,000. That's the only difference. The basis is $39,000 instead of $30,000. And the fair value is $40,000, and you're exchanging that for like-kind property with a fair value of $36,000. And to even up the trade, you're getting cash of $4,000. So this time the accounting gain or the realized gain is only $1,000. That's the $36,000 plus the $4,000 that's received. Compared to the old basis of $39,000, you've got a realized gain of $1,000, and the boot is still $4,000. So they'll ask you how much is taxable. That's always the lower of the two. Even though the boot is $4,000, this time the realized gain is lower. So you're only going to have a gain recognized of $1,000, not $4,000. So remember, what's taxable in a like-kind exchange is the lower of the realized gain, in this case $1,000, or the boot of $4,000. So you're going to have a recognized gain equal to $1,000. The problem with that is not all the boot is being taxed right now. You still have boot of $4,000, and it's not all being taxed right now. So the IRS says you just put $4,000 cash in your pocket, and we only taxed you on $1,000 of it. So the other $3,000 that you didn't pay tax on right now, you're going to pay tax on that later. Some other time you'll pay tax on that. How do we know? Because we're going to take your old basis of $39,000 and we're going to subtract $3,000, which is the boot that wasn't taxed today. We're going to make sure it's taxed tomorrow by lowering your basis down to $36,000. Why did we lower the basis when we didn't do it last time? Because this time not all the boot is being taxed. So you're going to start with the old basis, and then whatever boot is not being taxed, you're going to reduce the basis by that amount. So this time the basis of the new asset is $36,000. Start with the basis of the old and then subtract any boot that's not being taxed. I'm Darius Clark of the I-75 CPA Review course, and I want to wish you luck on your upcoming reg exam.